Hey guys, hope you're doing well out there. It is time to take a look at the EV industry, as really that's a space in the market that hasn't caught a bid over the past year and really has been feeling the heat year to date as well. So we'll take a look at three of what I consider the most important and influential names in the space, namely Nio, Rivian Automotive, and there's no story in the EV space at least complete without Tesla. So we'll take a look at that as well. We'll jump into some of the news stories surrounding these companies really over the past year to date, compare their earnings estimates and valuation. And look, while the fundamental stories at some of these EV makers are absolutely broken, the technical charts still might represent an opportunity for you to make some money. So we'll highlight some levels where I think if you have the stomach to maybe hold on to some of these names through large ups and downs, you still can make money from them, believe it or not. So we'll highlight some of those technical levels on these charts as well. As always, if you are new to the channel and find this type of content valuable, be sure to hit that like and subscribe button below. It would be much appreciated. Time to pick up the story over at the Chinese EV maker Nio, trading at right around $4.78. You're basically in penny stock territory with this one, and shares have declined close to 47% year to date. Absolutely insane. And just the fact that this company was once trading north of $30, $40, even $60 a share is something I find absolutely insane. As we look through these numbers, you'll see the outlook over at Nio looks extremely bleak, to the point where I would question whether this business would be around, let's say, 2 years from now. And so when we see the price underneath $5, close to penny stock territory, I think that is absolutely justified and really can be backed up by the numbers. So this was from their Q4 results, which came out earlier in the month of March. Revenues came in at $2.41 billion. See, that's not actually terrible for a company trading right around $10 billion in market cap to post up roughly $2.4 billion in top line sales for 3 months. Certainly not bad. From a price to sales, you can say this one trading right above 1 times. And so certainly not bad. Now keep in mind that was growth of just 6.5% year over year. And so the story really over at Nio isn't about the sales. Sure, the sales have slowed down and absolutely demand has fallen off a cliff. But really the story for Nio and a lot of these new startups and Chinese EV makers comes down to profitability. And so we see their Q4 non-GAAP EPS, or in other words, earnings per American depository share, came in at a loss of 39 cents. And that did miss estimates on Wall Street by roughly 7 cents. And so, like I said, the story really surrounds the profitability aspects of companies like this. Now, before we really break down the earnings story over at Nio's, from a deliveries perspective, this is actually one of the companies that is delivering at least meaningful amounts of cars every quarter. And so in their Q4, they delivered nearly 50,000 vehicles in the end of 2023. And largely that consists of their premium smart EV SUVs. And so year over year, that did represent a nearly 25% increase from fourth quarter of 2022, but quarter over quarter did experience nearly a 10% decline. And so I think that really is the story, that year over year, Nio is expecting deliveries to rise modestly, but the quarter over quarter declines really doesn't paint a great story, at least in terms of demand recovering over at Nio and really over at the Chinese EV makers. Now, also from a deliveries perspective, you have your vehicle sales. That came in at roughly $2.17 billion in Q4. Again, year over year did represent a modest increase, close to 4.6%, but quarter over quarter, you saw your sales on those vehicle side decline by 11%. And so you have that slowdown in deliveries quarter over quarter, translating right into your vehicle sales. Now, what Nio was able to do in the quarter was actually control their margins and even help those increase on a quarter over quarter and year over year basis. As you see, last year you were sitting at roughly 6.8% vehicle margins. That has come all the way up to 11.9%. And I think that's really important for these EV makers, is to protect those vehicle margins. If they start to get down to these single digits on those vehicle margins, it is going to be extremely difficult to remain profitable or even turn to profitability, as you still have extremely large amounts of operating expenses right underneath your gross profit line. And so these margins over at these companies extremely pivotal to keep an eye on. You really don't want to see them turn down to the single digits once again. Now, from an outlook perspective, over at Nio doesn't paint a great picture either way. As you see, deliveries are expected to come in right around 32,000 on their midpoint. That is for Q1. That would represent growth of basically 0 to 6.3% year over year. And so even the guidance over at Nio looking pretty bleak. They're not expecting demand to suddenly turn around, and they're expecting another few quarters of very extremely slow delivery and sales growth. Now, over at Mizuho Securities, they see EV storm clouds really all around, and they see Tesla, Rivian, and Nio all downgraded due to near-term headwinds. And so they remain cautious on the EV sector due to near-term headwinds, but also tightening liquidity concerns. And then the Japanese firm also warned on increasing inventory levels that could create yet another pricing war and really pricing headwind this year. Now, from I think the statement, the most important thing that I take is tightening liquidity concerns. For a company like Nio, where you see profitability really isn't expected to come into question until 2027. Yeah, that's right. You have to wait nearly 4 years to even expect this company to turn profitable. And that's based on just one analyst's estimate. So who knows in 2027 whether this company will really even be profitable. And so for a company that has to sustain another, call it 4 years of negative earnings per share, of losing money on the bottom line, that is extremely tough, especially in an environment where demand is weak and where pricing becomes extremely difficult with the amount of EV competitors you have in the marketplace. So you have to keep the prices on your vehicles low to remain competitive, all at the same time where demand is just simply not there anymore. And so you see year over year, the vehicle margins coming down significantly from 13.7% down to 9.5%. Again, that was for the full year 2023. We did see a pick back up in vehicle margins near Q4 up to 11.9%. But keep in mind, for the full year, it was still in the high single digits. And then on top of that, you have gross margins also coming down significantly, basically being cut in half down to just 5.5%. Look, when you are an EV startup and you have just 5% gross margins, it's basically impossible for you to make money just operating the business, let alone on the bottom line. You're losing nearly 22.6 billion RMB. So keep in mind, it's not US dollars, but Chinese dollars. But keep in mind, that did accelerate massively on a year over year basis, as you're now losing another 44% on your loss from operations. And then similar story translates down to your net loss, increasing by 43%. So this company is absolutely bleeding money. And especially when you have just 5% gross margins, when they're cut in half on a year over year basis, you absolutely will bleed a ton of money. And that leads to Mizuho Securities liquidity concerns. And we can really see that. It doesn't take a ton of analysis to really see that this company is going to run down the line of liquidity concerns. You basically have $4.6 billion. This is in USD as of the end of 2023, $4.6 billion of cash and cash equivalents, another, call it 780 million in restricted cash, and then we'll give them credit for another $2.4 billion in short-term investments. So you're basically looking at right around $7.5 billion in cash and short-term investments. And we come down to their statement of comprehensive loss. Yeah, because they're not profitable. On the right-hand column, we have in US dollars, this company burning through roughly $1 billion in loss from operations. That's not for the full year. That is for 3 months ended. Burning through roughly, like I said, $1 billion. That is accelerating on a quarter over quarter and year over year basis. And when we come down to their net loss, losing roughly $750 million, again, in 3 months for the full year, paints an even worse story. You're basically running this business on a vehicle sales basis at a break-even perspective. You see year over year, that gross profit is declining substantially. And then in 2023, gross profit coming in at just $430 million US dollars. That is not a whole lot on close to $7.8 billion of total revenues. On top of that, you have a couple $1 billion in operating expenses, namely $3.6 billion worth of total operating expenses. And so for the full year, your loss from operations coming in at roughly 3.1 billion US dollars. Yeah, we just saw this company is sitting on roughly $7.5 billion of cash and short-term investments, and they're burning through close to $3 billion in a year from just operating the business. That certainly is not a great picture, in my opinion, over at Nio. On top of that, they do have debt, as we see long-term debt coming in right around $1.8 billion, and then non-current lease liabilities coming in at $1.4 billion. So for a company trading at right around 478, they will definitely have to continue to raise money. As we see, they can maybe sustain another year or so of these losses before needing to raise significant amounts of capital. And the only ways to do that is via an equity offering or through the debt markets. And certainly when your stock is close to $5 a share, you won't simply be able to raise a ton of money through equity. And so you're going to tap into those debt markets at extremely high interest rates. And that is simply on the hopes and dreams that you will eventually one day down the line, maybe in 4 or 5 years, turn to profitability. So I think this company still is a long, long way away from being profitable in the slightest bit. And the fact that they have so many products out there that they're looking to ramp, look, they're still able to deliver vehicles. And that's not the issue over at Nio. The issue lies in the ability for management to realize that if they don't stop this cash burn and focus on turning to profitability sooner, yeah, they simply won't have the ability to deliver cars because they are going to go out of business. So I think that's really the important story over at Nio is the company really has to focus on profitability. And if they don't, as an investor, you are just going to keep getting diluted and simply be holding on the basis of hopefully Nio one day turning to profitability. And I guess one thing before I jump into Rivian, I forgot to mention the other inherent risk with a company like Nio is the fact that you're really buying into those American depository shares. This is a Chinese company. And so not only do you have the risk of possible future bankruptcy, you have the overhanging geopolitical risk that you always get with a Chinese company. That's one of the reasons, pretty much the only reason why I don't consider buying shares in Alibaba, just because you have the inherent risk of it being a Chinese company and the geopolitical overhang. And so I think as a Nio investor, that's another thing you would have to keep in mind anytime you're considering one of the Chinese EV makers, whether that's Nio, XPeng, or even a Li Auto. Now, moving on to Rivian Automotive, the story over at Rivian really doesn't get a whole lot better. In fact, I would say it actually gets worse. You're trading at roughly the same market cap over at Rivian as you are with Nio. So you're looking at roughly a $10.5 billion market cap. And keep in mind, Nio delivered right around 160,000 vehicles last year, whereas Rivian close to 50,000. So you have a big difference in the amount of deliveries, but looking at relatively the same market cap. Now, maybe simply because Rivian is an American company and you don't have that China risk, that could be one of the reasons why Rivian could demand a slightly higher premium, at least in the American markets, compared to Nio. Now, what Rivian owners are now able to do is charge at Tesla supercharger stations. So in my opinion, this is actually a story mildly bullish, at least for Rivian owners and also potential Rivian buyers, as you see the Tesla supercharger network nationally has opened up to Rivian EV trucks and SUVs. And so Rivian owners can now charge their cars using the NACS to CCS adapter at Tesla supercharger stations. And again, like I said, probably bullish for Rivian owners just simply from the fact that they're now able to take advantage of the Tesla supercharger network, which in my opinion is probably the best network for EV charging, especially considering you have other charging companies like a ChargePoint, like an EVgo, or a Blink Charging that themselves aren't doing a great job at building out your superchargers and really charging stations across the US. And so Tesla opening up their supercharger network, probably a bullish thing for Rivian owners, considering now they have another reason to maybe go out and buy a Rivian and now that they can use Tesla's supercharging network. Now, over at Piper Sandler, they do say the new cars and the CapEx plan breathes life into Rivian thesis, and they upgraded the stock based on that. So something I actually disagree with here on this Rivian story, the fact that Rivian unveiled 3 new vehicles, the R2, the R3, and the R3X, that is something Piper Sandler actually considers bullish and rated the stock to overweight from neutral. In my opinion, I think, yeah, sure, revealing these 3 new models, great. Showing the product map over at Rivian of what is expected to come, and especially the R2 is a 5-seater midsize SUV, and the R3 will be the company's midsize crossover entry. And I have looked at the reviews for these cars from famous YouTubers on the tech side, namely MKBHD, and in my opinion, frankly, look pretty good. The cars look themselves quite good, and they seem to be a good EV SUV option. And then on top of that, Rivian did say the R2 is expected to start around $45,000. That is, in my opinion, extremely reasonable. And then on top of that, you have the R3 that's expected to be priced somewhere below R2's starting point. And so over at Rivian, you have 3 new vehicles that, in my opinion, look pretty good, have probably pretty good specs, and then also priced at a very reasonable $45,000 and below starting price point. That should be bullish, right? I absolutely don't think so, as while the R2s are able to be reserved today for $100, the deliveries aren't expected to begin until the first half of 2026. That's right, you have to wait nearly 3 years for the first deliveries of the R2, and then on top of that, the R3 and the R3X deliveries will start after the R2. And then on top of that, you don't have production for the R2 planned until the first half of 2026 as well. And really, if we've learned anything from Tesla ramping up their cars, is these estimates and predictions for deliveries and productions really tend to get pushed out further and further the closer we get to it. So I wouldn't really be surprised if you don't expect deliveries until 2027 at some point. And so, yeah, while they have these 3 new vehicles expected to give a boost to Rivian's revenue, especially considering their much cheaper price, that really won't go into effect until the first half of 2026. That's based on what management says, but really, I think the difference won't be felt until 2027. And as we look ahead to the earnings estimates over at Rivian, this is even worse than Nio. They aren't expected to turn profitable until 2029. This, in my opinion, is just frankly ridiculous, expecting a company Or in other words, betting on a company so early, especially when they're so far away from turning profitable. You have to look ahead to 2029. And until then, this company has to survive taking those huge losses. And I just honestly don't see that happening over at Rivian. You're basically selling the cars over at Rivian for free, as you have nearly $4.4 billion in top line revenues, which cost nearly $6.4 billion to generate. And so your gross profit is negative. This is basically the line where you should absolutely stop looking at Rivian's financials. The fact that they have been gross profit negative for the last 3 years is they are basically giving to the cars over at Rivian for free. On top of that, you have another $3.7 billion in operating expenses. So you're burning roughly $5.7 billion worth of loss from operations in a year. Yeah, that is absolutely absurd. When we take a look at their cash flows, it doesn't paint a better picture. You have roughly $4.8 billion of cash used in operating activities, and then another 2.5 used in investing activities. So what is that? Roughly $6.3 billion worth of cash burned over the course of 1 year. When we take a look at their balance sheet, they're sitting on right around $9 billion worth of cash and short-term investments. And so you're basically looking a year out for Rivian to just survive this sort of cash burn. And they'll likely, similar to a Nio, have to do a large equity offering or raise a ton of cash. And you're basically looking at these shares outstanding, which have quadrupled over the past 2 years to likely, in my opinion, at least double from here. And so as an investor, when you consider investing in Rivian, you have to realize that this company really isn't expected to be profitable for the next 4 to 5 years. And to hold through that time is going to be extremely tough. You will be diluted to the sky. And then on top of that, you still have a bankruptcy risk after all of that pain. And so really, I think the story over at Rivian is too early. Forget about being positive on a net income basis. I think Rivian should first focus on being positive on a gross profit basis. I think because this is negative, that is really just where I would stop my analysis in Rivian. Time to take a look at Tesla, and really no EV story would be complete without analyzing the industry leader. And not just an industry leader in the cars, but also in the manufacturing, in the robotics, likely in the autopilot and full self-driving. Along with that, an industry leader in battery and charging infrastructure. And so really, that just makes it difficult for me to see any of these competitors really catching up to Tesla, even call it 5 to 10 years down the line. Now, you still have shares of Tesla struggling year to date, close to 30% down on a year to date basis. And in fact, is the worst performer from the S&P 500, as it was down close to 30.5%. So you still have the pain over at Tesla being felt. Despite it being an industry leader, it's not immune to the demand struggles and the price wars that really this whole EV space is feeling. Now, Tesla did offer US customers a monthly trial of its driver assist technology. And this, I think, came out today, that Tesla is now offering a 1 month free trial of the driver assist technology, otherwise known as FSD or full self-driving. And I think this is actually a great move over at Tesla, as FSD normally is right around $12,000 if you buy it up front, or on a subscription basis, close to $199 a month in the US. And that is a pretty steep price tag, at least for the average Tesla customer. The fact that they probably paid close to 30, 40, if not 50,000 for their Tesla model, and then on top of that have to pay another 12 grand or another 200 per month in order to just access that FSD. I think having this 1 month free trial is beneficial to Tesla for a number of reasons. First of all, if drivers choose to use this, they'll just get a bunch of data that they need to collect anyways in order to improve that last 1 to 2% of FSD. If you have a bunch of Teslas on the road using the free trial, you'll be able to collect the data on a ton of those cars that previously probably wouldn't have considered full self-driving, and you can use that to make the algorithms on the FSD a whole lot better. On top of that, you have basically free advertising where you're able to give a 1 month free trial. You're able to have those customers feel what FSD really is and how good it really has become over the past few years. That itself is going to likely convert a lot of people to sign up for FSD after the end of their free trial. And if not, they'll likely at least tell their friends and family how good FSD was while they had the free trial. And so I think this is actually a great move over at Tesla, basically giving customers a 1 month free trial in order to use that great technology. On top of that, in order to promote FSD, Tesla is now requiring staff to demo it when customers get their deliveries of the new Teslas. So again, similar move. I think it's basically just needing the customer to be shown how good FSD really is. And that is a hard requirement, even if that slows down the process of delivering vehicles. And I think that's great. FSD really is a high margin business. Basically, all of it is software-like margins. And so if you can have more people converted to buying the FSD software, I think that can be very helpful for Tesla's margins, which absolutely have taken a hit. Now, the only thing with offering this free trial of FSD, I can see one downside, and that is a lot of people will likely choose to sign up for it. And then you might have an increase in the crashes, or you might have increased possible accidents coming from FSD and Tesla really using FSD. And so if that does increase the number of headlines that possibly come out due to it, that could be a negative catalyst for Tesla. Just the fact that maybe it will show people that FSD really isn't ready to the point where it needs to be. But again, that does tie into our first point, where they'll get a ton of data and can likely use that to improve on FSD down the line. Now, Tesla does come back to Facebook, sending cash into Zuckerberg's pocket. So Tesla did make an announcement to once again restart advertising on Facebook and Instagram as well, a place where they haven't advertised for nearly 6 years. But due to that extreme slowdown in demand, I think Tesla needing to once again go down the route of advertising, probably not the best sign for demand again. And Tesla once again probably needing to spend more on marketing down the line. Now, another story basically showing that the demand over at Tesla is really struggling is the fact that they're reducing the EV production over in China. Tesla in their Shanghai factory did ask employees to lower production of both the Model Y and Model 3 by working only 5 days instead of the usual 6.5 days. And the output has been trimmed, and staff haven't been a clear indication of when production will go back to normal. And that's largely, again, due to the fact of slow growth sales in new EVs over in China, and also on top of that, rising competition. So really demand is looking bleak, not just over at Nio and Rivian and XPeng and all the other EV makers, but also impacting Tesla to a pretty big extent. The other thing that really has impacted Tesla over the past year is their margins, and the fact that they've had to reduce prices on all of their vehicles by a significant amount has reduced their gross margins, their vehicle margins significantly. But finally, it seems like that pricing war is at least coming to close to an end, as Tesla is looking to raise prices of its Model Y by roughly $1,000 in the US and close to $2,000 in Europe. And it seems like Tesla is seeing the ability to at least incrementally increase the vehicle prices to hopefully bump up those operating margins and gross margins in the subsequent few quarters. You likely will have a bottoming out of margins, in my opinion, in this quarter or the next quarter over at Tesla. And from there, you'll likely see incremental increases in your margins. As you see in the most recent quarter, they came in with 8.2% of operating margins, whereas last year they were closer to 16%. So like I said, I think margins will look to bottom out sometime this quarter or the next quarter. Now, you also have this company being profitable for a change compared to Rivian and Nio, but you do have earnings expected to decline in this calendar year. Now, the important thing is Tesla is expected to see the earnings ramp once again back up starting next year. And so having to deal with a slow demand and really pricing wars is manageable, at least from the fact that they are profitable and don't have the risk of raising capital and possibly going bankrupt. And so that's why I think while Tesla has been the worst performer in the S&P 500 this year, it still is a much, much better play, at least from a risk standpoint, compared to a Nio and Rivian that likely, in my opinion, have liquidity concerns coming extremely soon. Now, speaking of Nio, while the fundamentals over at this company are basically in shambles, from a stock chart perspective, you are making a pretty predictable trend of lower highs and lower lows. And so if you are looking to step into shares of Nio, again, not from a fundamental perspective, but from a technical perspective, the first level is likely near the bottom end of this range, closer to, call it $4.10. And you want to play the ripper rallies that this stock experiences, likely from the bottom end up to call it $7.5 a share. And so from a swing trading perspective, shares of Nio actually not looking terrible if you look to buy them at the lower end of this channel. And as they come closer to the middle or the top end, you take your profits. Now, the only way a trade like this can really be successful is if you have extremely convincing buy and sell targets. You don't deviate from your plan. And so as Nio continues to head up, you look to take your profits at these levels. And then to avoid downside risk, you would definitely set an extremely hard stop loss right around, call it the 390 level. In case Nio does break that, likely will come back close to the $2 range. And then you want to set a trailing stop loss as it goes higher and higher. That's going to allow you to lock in your gains at these high prices. And so really that's the only way I would look to invest in Nio, is if you want to play a popcorn swing trade, you can look to pick it up at the bottom end of this channel. And basically anytime it crosses the middle, you can look to take those profits. And these are pretty large swings in shares of Nio, close to 80-90%. And so you can look to swing trade this. Wouldn't be something I would be interested in doing, but can certainly be an opportunity to swing trade shares of Nio. Similar story over at Rivian. You're basically making a pretty similar pattern of lower highs and lower lows. You have even larger swings over at Rivian, close to 100% from the bottom to the top end of this range. And like we said with Nio, a similar story. You basically want to pick up shares close to the bottom end of the range, really where they are right now. I'd say maybe closer to $960, $970, and then look to play a swing trade closer to, call it $19, $20 a share. And so that is really how I would play Rivian as well. Look to pick it up on the lower end, set your trailing stop loss as it heads higher, and really anytime it crosses over the middle of this channel, that is where I would look to take my profits in Rivian. Now Tesla, looking a bit more interesting than the other two. You are still making a pattern of lower highs and lower lows, is wedging out more so compared to the other two companies. And so near the bottom end of the range, you can look to pick it up, I'd say closer to $170, really close to where we are right now. It did make a bounce off this $170 level. And so I wouldn't be surprised if shares of Tesla come back and retest our highs closer to $240 a share and then possibly get rejected at these levels. And so you can look to swing trade Tesla from that perspective. But the other way you could also play this is look to buy shares here and then continue to hold them and maybe look to dollar cost average as it heads lower. Your first level of support is really sitting right at $154 a share. Really, if it breaks this $150 range, you're probably coming down south closer to $110, $100 a share. And I think in that range would be extremely attractive to pick up shares of Tesla for the long term. This is one of the few companies that I think can buy in this space for the long term, simply because the fundamentals absolutely back this company up. You have weaker demand in the near term, but the fact that this company will easily be able to sustain that due to its high level of profitability, that in my opinion is one of the reasons why I think you can buy and hold shares of Tesla, something you can't do with a Nio or Rivian. We also have Tesla's earnings coming up basically 3 weeks from now, closer to 17th April of this year. And so certainly if it can rally into earnings, that could be a reason for it to set up near the top end of this range and then possibly get rejected depending on what kind of earnings they announce. So be sure to stick around on the channel. We'll have those earnings when they come out. We'll also have the earnings for all other big tech companies right around the same time. So be sure to subscribe to the channel so you don't miss out on those future uploads. That was my take on shares of Nio, Rivian, and Tesla. I think it's pretty clear which one stands out of these three companies and really which one stands out for the long term in this space as a whole. Let me know your thoughts on these companies in the comment section below and what you think of the EV space. We're basically 2 weeks away from earnings season ramping right back up. And so on the channel, we'll be sure to cover all the major bank earnings and then tech earnings. So be sure to subscribe to not miss a future upload. As always, thanks so much for listening, and I'll catch you guys in the next video.